over, just in case we're not live yet. We don't want to miss any pearls of wisdom from today's guest because we've got lots of important stuff to discuss. Okay, here we go. We are live on the Facebooks and all the other social medias of the world, which I lump together because really I'm a podcaster. I love podcasts. I hope you do too. If you're listening on the podcast, then welcome. If you are listening on social media, live or on the replay, we're talking about two important things today. First of all, Aggregator Agony. Is it in fact Agony? What's going on with aggregators? They were all over this place buying up Amazon businesses even 6 months ago, and now they seem to have gone quiet. What's going on? And then also, if you need to sell, or in fact, if you need investment and want to grow the business, what do you do? So here to talk about it is Chris Shiplin from Global Wide Advisors, really expert people in this area. Chris, welcome back to the show. Good to have you again.
Thanks so much, Michael. Appreciate it. Love your podcast.
Thank you, man. I feel like we're overdue a visit from you because I've been hearing speculation from Amazon sellers about what's going on and the markets and you know,
the water cooler is heating up.
Yeah,
water cooler chatter is heating up.
Yeah, it is. So I thought, you know, let's go to somebody who deals with this day in, day out and does it properly.
Yeah.
So we're going to record a podcast in a second, folks. So if you're listening live or on the replay, feel free to pop any comments in. If you're listening live, we'll try and weave them into the show, but questions or comments about selling your business investment, or, you know, in an Amazon or e-commerce focused business, or about aggregators, any of those things, fine. Do not ask, please, if you should start a retail arbitrage business or what's going on with the wholesale sourcing model or random stuff, because we won't respond. So it's about the subject, please comment away and we'll weave it in. Otherwise, if you comment after the show, we'll try and get to it and respond to your questions or comments. Always trying to do that. So that said, Chris, let's get on and record this podcast. So here we go. Ladies and gentlemen, welcome back to the 10K Collective podcast for 6, 7, and 8-figure Amazon business owners. Today, we are talking to Chris Shiplin from Global Wide Advisors, and I'm always glad to talk to these guys because every 6 months is roughly when we end up speaking. And my goodness, every 6 months, everything changes because we're talking about Amazon aggregators. Is it aggregator agony, or what's going on with them? Are they buying businesses anymore? And the other basic question we're going to deal with in the next episode is really, you want to sell, or maybe you don't want to sell, but you need an injection of funding. What do you do? So Chris, welcome back, first of all.
Thanks, Michael. Yeah, man, this is, you know, you were the first podcast Global Wide Advisors ever did in this Amazon space. So you're the OG.
Yeah, come back for more. Good to have you here. And so first of all, let's talk about Global Wide Advisors, and just for anyone who hasn't heard of you guys, just 1 minute, 60 seconds on you and why people should listen to what you have to say.
Yeah, no, again, appreciate coming on. And, you know, we're a lower middle market investment bank with, you know, careers that have spanned over 20 years in institutional investment banking, as well as myself. I worked over a decade and a half inside of CPG, from companies 22 to 500 million, having worked with, you know, Amazon.com since before they even had a Seller Central, working only with a random book, as I called them, the random bookseller, back in 2003, having worked with Wayfair when they were called CSN stores. So extensive experience inside of e-commerce and really watching it flourish and become more of a important measure of retail sales. So that's a little bit about our background, so we can kind of set the stage on some credibility. Yeah, so we are focused on sell side transactions, but in recent history, just kind of given where the overall market is, not just the aggregator market, which is what we'll get into, or the aggregator takeout, as we call it. We've pivoted a little bit more towards advisory and consulting services. So, you know, whether it's growth consulting, you know, helping the brand owner find all the right resources and business planning, to fractional CFO services and et cetera. We've really been pivoting over the course of the past year into offering much more advisory / consulting, and really being, I'd say, good stewards and telling people to wait. It's okay. Just wait till the market gets a little bit better. Wait till your business gets better. Wait till we start to see, you know, much more, call it, you know, flourishing inside of the space. So
yeah, so you've given away the punchline. So wait is you're in a hurry and you haven't got any time to listen to the rest of it, then shame on you. You should go and educate yourself. But no, joking apart, we're all busy. So wait is the summary. So just to translate for those of us who speak small business owner rather than of institutions, so low middle market investment bank, the really crude thing that you'll probably hate me saying, but to explain it, broker, more or less, right? You stand between the owners of businesses and the people who buy them. Although I know that you have more sophisticated techniques and processes that come
Yeah,
from,
that's right.
many years in Wall Street, right? So put it in.
Yeah, that's right. And I think the best way to boil it down is you really have two types of intermediaries in this space. You have a banker and a broker. And a banker is going to come with a much higher level of sophistication. We're going to be much more diverse in the way that we can help the company. You know, we can do lots of advisory work. We can do lots of growth consulting. We can do lots of, call it true BC or business consulting work, outside of just a broker who is going to only list your business for sale. That's it. That's all they do. They don't even really navigate your way through the best way to do it. It's more or less, we're just going to list your business for sale. So no disparagement, but that's really kind of the fork in the road, where you've got the banker who's going to bring a lot more, I'd say, thought and strategy to the sale, and a broker who's going to just be a pure tactician when it comes to just your business.
Yeah. I know brokers who might disagree with that distinction, but nevertheless, it's a clear statement. So, I mean,
bring them on, Michael. Bring them on your podcast. Let's do it.
I've got lots of them. What I should do is a panel discussion, aka fight with me as the referee at some point. That would be fun. But joking apart, 20 years in institutional investing, that sort of Wall Street connections. I know that you've got your partners like Jason. He's got that years, 20 odd years in institutional investing.
Yeah, it's just a lot of. It's good strategic thinking, and I think it's germane really when. We're having discussions around what we're about to talk about, which is, hey, I'm a business owner, and the bullish good times as an Amazon business have the music stopped. What the heck do I do right now? And I think
so the music
that's where you really start to see the fork in the road.
That's great. Sorry, that's good. So the music stopped. It sounds like a quote from, is it Margin Call? That one where they got Jeremy Irons, the British guy.
Yeah.
And that's a great. I love the movie. I don't know how accurate it is, but it's all about the subprime thing and basically people passing around bad debt to each other until somebody goes, yeah, we can't keep passing this on anymore, and they just kind of flood the market with it and get out. Can't remember which company is supposed to be. I guess they didn't name it for fear of lawsuits. But so are we having an Amazon aggregator moment like that? So you think the music stopped for Amazon aggregators? Do you think the music stopped for Amazon? Has it stopped for the entire CPG, aka consumer packaged goods, products, physical products type, e-commerce type goods? I mean, how far does this go?
No, I mean, look, from a macro perspective, and I'll get off this kind of fairly quickly. There's just a lot of volatility, and there's a lot of question marks currently on where we're headed. We actually just sat in a conference room yesterday, the three of us, myself, Jason, and Joe. And Joe put together a macroeconomic presentation for us to view on where he believes we're having a recession scare, when the recession is going to happen, and of course, a historical chart of M&A post-recession, pre-recession. So right now we're a little bit in that phase, what feels like a pre-recession, where M&A activity does slow down, advisory activity, consulting activity, growth. The what the heck do I do phase as a business owner, especially a small business owner, you feel that effect more than, say, a larger enterprise company or even a medium-sized business. And so I think we're in that phase right now where it's, transactions are still getting done. There are still aggregators buying, by the way. But what's happened is this idea that we've got lots of venture capital and mainly debt flooding the space right now, and we're looking for anything that basically breathes. That's how it came in. If you got profit and growth, which unless you were deaf, dumb, and blind, it felt like during the COVID pop. Of course, I'm just being, cheeky, as you would say. But if everyone experienced that, so everyone seemed to be seemingly was a candidate. But the problem was you had a lot of these M&A teams. They weren't chasing brand. They weren't chasing product development. They weren't chasing patents, utility patents, and a brand that's prolific and has awareness and has reach and has diversification. They were chasing, I want evergreen product and profit, right? Well, what happens when COVID now comes away? A correction happened. We looked at a chart yesterday. It went up like this and it corrected. We're still at a higher clip than we were before in terms of e-commerce sales overall, which is good. But you had this massive correction, and then a lot of these brands, quote unquote, which is tough to say for Amazon, isn't always necessarily synonymous. They were immediately commoditized, right? And so because of it, you had a lot of these products that were purchased by these larger aggregators, and you ran into two problems, right? One, a lot of the purchasing was done incorrectly. And then when you took the incorrect purchase through the conveyor belt of operations, it broke down quickly and continues to break down. And so when that happens, what do investors do? Investors care about one thing: return, money. That's all. And they'll invest in anything. They don't have passion for whatever. Their passion is money, right? And so as soon as they're starting to see this and their return starting to slip, all the reins get pulled in. And that's effectively what we're feeling. We're feeling the larger investors pulling in the reins. Guys, go through a restructure. The aggregators are feeling the pressure right now. The M&A teams are feeling the pressure. You better buy. If you're buying right now, you better buy really good, because we're watching like a hawk. And so really what's happening is, and it's painful, it's a lot like when you decide, I want to get in shape, right? Those first like 8 workouts are hellish. But then slowly but surely you get used to it, and then your endurance builds up, and it just becomes a normal part of life. A lot of the aggregators are in that period right now where they're just trying to figure out, okay, this really doesn't feel good. I've never done this before. It hurts. And so there's a lot of restructuring that's occurring. And that's a great thing for the space. So as a business owner, how do I view all of this? Well, number one, if you want to go sell your business right now, if you're looking to sell your company to an aggregator, just know that the amount of people buying went from here to about here. And number two, multiples went from here to about here. So if you're okay with that, and you've got a well-protected brand, what you believe is a good brand, growing, and protected product, but growing, showing growth and good profitability, there's more than likely a chance you will actually sell your company. But just understand that you're not selling it for 6, 7 multiple anymore.
Yeah, right.
That was
then.
That was the crypto market.
Yeah,
right.
That was crazy. And by the way, we're talking just to put I want to regret this because it makes it less evergreen. We're talking August 2022. I think the aggregator thing is just like is so un-evergreen. That was my first book that I was trying to put together for the podcast, and I'm regretting it. But hey, so August 2022 is this conversation. The last time I really dived into the aggregator thing was talking to a client who just sold to an aggregator for 5.5 times, and the brand was well done. The EBITDA was like 30%, or STE, whatever you're going to call it. Pre-tax profit was good. They sourced in the UK, sold in the UK, so there was, working capital requirement was lower. It was therefore an attractive business. But I swear, if they tried to sell it now, there were so many legal issues and what have you, bits and pieces around it, that I don't think it would even sell. And if it did, then
you're probably right.
So much back. So I think he sold at the bang on right time. So what strikes me then, and my logical response is, as a business owner who's going to be savvy about certain things, okay, the number of people has shrunk, or number of people buying has shrunk, the multiples have shrunk. If I've got a good brand and it's protected and I'm growing and I've got good profitability, I'm presuming that now is therefore a silly time to sell. Because if I've got growth and those other things, then I should have a more valuable business in future when the values have maybe reinflated. Is that your view as well, or how would you?
I would say yes and no. So I'm not going to go too egregious and be like, oh, no one should sell right now. The music stopped, just stop. No, I'm not. Definitely don't want to preach that message. What I'd rather say is, hey, look, speak to a professional, someone who can look beyond what's happening now, someone you can trust to kind of understand where can I anticipate the as you would say in the UK, the football, right? In footy, where will the football be as I'm running down the pitch, right? Because right now that's basically what's happened is the soccer ball has now been, or football has now been kicked, and I need to anticipate where it's going to be while I'm running down the pitch. And so when you speak to a professional who's got a little bit more of a longer term view and strategic view, you can really dig in and understand, okay, where does my business need to be in order to now be that valuable asset down the road? Or two, hey, look, you have a real shot at moving out of just, we always talk about aggregators with Amazon businesses. They're synonymous for a reason, because that's the liquidity that's been chasing them. And outside of that, it can be very difficult to get a deal done with private equity, family office, if that's all you are, is a 100% concentrated Amazon business, right? But I would say, look, if you've got, we can assess if you've got real legs, power to go outside of just a aggregator process. And I'd say that's also the unfortunate thing with the education when it comes to exit planning in this space. It's all been around, look everywhere. And I don't blame anybody for having this strategy, but it's just a very myopic view of how you should be speaking to a brand owner about their business is, oh, well, let's just get you to an aggregator. We can talk to you about the tenets of a business that we know a more strategic capital provider would be very interested in. And so that's the other thing that I would talk to a business owner about. And I don't want to get too ahead of myself, but look, it's time for us to take a seat and realize that the way that most of us were taught how to sell product just through Amazon was very much diabolically opposed to the way that you're taught how to run brand at Procter & Gamble and Unilever and J&J and Kimberly-Clark and real trade brands, no matter where you go, right? That was one thing I had to wrap my brain around. I come from a more traditional CPG, which is you've got your product development team and product is king, and you're really heavily focused on product development. You're heavily focused on protection and IP. You're focused on brand marketing and how can I be prolific with my brand? What does that look like? And then, different sales channels. That was the one thing that when I was at a much larger company, it was about a $500 million company, and we sold in lots of different retailers. One of our larger retailers represented close to 35% of our revenue, and it was Walmart. And I remember sitting in boardrooms and all of us around the table sweating because we're like, that's way too much concentration. That's 35%. That's too much concentration. We need to become more diverse, right? And so that's where I think this time period is a good time period for brand owners to really become much better educated on how to really be a good brand, become more prolific, and show the growth that can make them a much more valuable asset down the road. I really do think this is a good time to do it.
That makes sense. I guess so in a way, what surprises me is not what you're saying now, but the whole aggregator phenomenon, really, because I was looking around and speaking to business. I think the first conversation I had with somebody who'd specialized in Amazon business brokering, if that's even a thing, was back in about 2016. And that was a fairly lone voice, and he really kind of cornered the market for a while because it wasn't a big thing, although there were transactions, and he sent the newspaper out, sort of newsletter every month and showing the transaction volume, and it did seem to be growing. So he was onto a small but niche thing. And then it blew up with the aggregators, who suddenly decided that concentration risk and all the other like Amazon suspension risks that goes with that, just like if Walmart decides they don't like you, or if you've offended somebody, one of their buyers, or you broke a law or a regulation or whatever. So it's concentration risk, right? To put it in generic bucket. Suddenly the aggregators seem to not care about that, and now they do again. And this thing that surprises me is that they ever decided not to care about it enough. So what was it that they saw that caused them to overlook what seems like an obvious problem, and why have they decided that it is a problem again?
Arbitrage, pure and simple. They wanted to arbitrage the multiple, and that was pretty much the thesis on every investment deck. At its core, it was arbitrage. I buy low, it goes on my balance sheet, it gets wrapped in with the entire fund, and now all of a sudden, what I bought for 3.5 is now a 15-20 multiple. So that was proven to be not the best model, clearly.
I was going to say, so why is that? And equally, I'm sort of trying to pick holes in why the heck was it one way, and why they changed their mind now? Why is that thesis any different now? Is it because it's been proven to be nonsense? Have they had enough time to even prove it? When they only kind of started buying like crazy about 18 months ago, didn't they? So
yeah, well, multiples got overheated, number one. So businesses that had no, like for instance, and this was public knowledge, like Factory 14, they bought a bike business that dropped EBITDA 60% a month after they bought it. And it was solely concentrated on Amazon. And so there was a lot of just arbitrage opportunity that turned into, now we got to operate these things, and the operations broke down quickly, because that's another thing. And this is getting a little bit minutia, but it's a very, 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 very valid point. You start to take away the brand owner from running the business and you hand it to a brand manager, frankly speaking, never ever ran a business before, has never been an operator. And you're sticking them in this new fund with all these new people who've never worked together before. So there's like zero simpatico, right? Within anybody, no one's really everyone's kind of learning their way. And, but it's a fund. You've got to show inflection fast. And really the model just broke down. And so what we're going to see on the other side of this, and I'm already starting to have really strong, good conversations with some of the aggregators, like I'll give them a huge shout out. I think Elevate is doing it the right way, man. They are thinking about the future of their brands in a very, very professional way. And I'd say there are others out there, but Elevate kind of being one of the larger ones. I think where they're headed, in the conversations I've had with those guys, they have their head on their shoulders for sure.
I got to agree with that, because I spoke to both of the Bells. I think it's Jeremy Bell who came on the actual show, and I spoke to I don't know if she's still there even, but their chief marketing officer. They'd taken on Lo Marta, I think it was. Just fantastically head screwed on, and they had somebody heading up the marketing who utterly understood the nuances, I thought, of consumer, CPG, consumer product marketing, and the guys who did the acquisition side were clearly expert acquisition, but they weren't relying on that single sole focus expertise. Because what strikes me as a total amateur in the investment space is that they knew a lot more than I did, and I've been very educated by a lot of conversations with a lot of aggregators on the how they evaluate businesses. But what they hadn't thought about is the same thing that was it 101 brands that the thesis somebody came up with several years about, the idea.
Yeah, 101 Commerce. Yeah,
those guys, 101, and the same thing occurred, which is that they bought about 20 brands, and at that point 20 brands means probably 50, 60, 70 Amazon marketplaces, because you got international ones, and the management piece just blew their minds. The same reason that I remember Warren Buffett saying that he wasn't going to buy a bunch of real estate, but the numbers on paper were, every so often, depending when you invest in the US or for that matter in the UK, real estate or property looks incredibly attractive as an investment, and many people have gained a lot of wealth. But to scale it is a nightmare, because you've got to find a lot of competent property managers, and anyone who's ever dealt with a property manager, either as a tenant or as a landlord, knows that they're pretty terrible mostly. So it seems to be the same thing, right? I mean, the numbers may stack up, but they fail to take the Warren Buffett wisdom into account, which is the management's going to be a nightmare, and don't do it. Is that really what's happened, or what is that?
I think in most cases, I mean, look, I think what you have is you had a thesis breakdown, man. You just had a thesis breakdown, and a lot of pivot, a lot of restructuring that has to occur. And unfortunately, you're going to see a body count, man. It's already happening. We've seen Factory 14 merge with Razor. We're going to see more of that. We're going to see more of these aggregators that have been out there in somewhat of a prolific way. You're going to see their unfortunate demise, and a lot of it is they either couldn't keep up the gross, their debt payments got too expensive, they weren't able to recapitalize the debt and make it cheaper. They weren't able to get new equity to bridge, or new debt to bridge, kind of call it the slowdown of what's currently happening. And in general, I mean, look, sales online slowed down because everybody went back to brick and mortar for a minute, right? And we're feeling that correction. So a lot of aggregators, they needed the bridge. A lot of them had lots of, I mean, take Thras, for instance. I heard they had over 400 million in inventory. And I think we haven't heard much from Thras, and I think what they're doing is probably the best thing they could possibly do, which is because you had institutional investors going, I'm sorry, it's time to restructure. We've got to think about this completely different than we did 4 years ago. And they don't have an M&A team. It's done. They're full on operator right now. And they're probably going to be that way for a couple of years, because they've got to restructure, they've got to rationalize, and they've got to really turn into now what they've purchased, and they got to start turning it into a return. So that's all the investors care about, is a return. So I think, that's mainly what we're seeing and feeling. And the reason for, I'd say, call it default or failure, et cetera, was a myriad of things. On paper, to your point, man, it looks good. Investment deck looks good. And then you start to execute and you go, we're feeling the breakdown. We're feeling the breakdown. And also, too, I don't believe that Thras and Elevate was one of the earlier ones. Perch, I don't think they realized in their investment thesis that in less than a year there'd be 100 of these aggregators.
Yeah, I guess they hadn't. I mean, in a weird way, to an Amazon seller, all of it looks incredibly familiar. I mean, number one, Amazon being a nightmare to operate and inconsistent and sometimes surprisingly clunky for a highly automated system. As a seller, the automation becomes a barrier to scaling and operating rather than an asset for you. And then also the fact that when you pile into something that's attractive, 100 other people pile in within about 6 months. To anyone who's sold on Amazon for a while, that feels very, very familiar. I guess that nobody had quite done that thing before, so you couldn't have a history to predict that. But I do think the operational difficulty shows a degree of, can I say, maybe ignorance is the polite term. I mean, maybe I'm trying to avoid the word arrogance, because I just think anyone who's actually operates on Amazon.
Yeah, no, there's a blend of
could
both.
have told them that. I mean,
yeah,
if
there's a blend
hired
of
a few
both.
Amazon sellers, if they hired the people who were selling brands to them, I guess they weren't going to say it's really difficult to buy my brand. But if they'd hired a few people as consultants who'd sold on Amazon for a few years, I think they might have got, that message, but maybe they just wouldn't have believed them because they were small business operators and they thought they were operating on a different level. So it's interesting. But I guess, look, it's crying over spilt milk. And I think we ought to wrap this episode up, because I know we've got to do another one about what people should actually do if they want investment, which I'm very, very interested in. So I don't want to miss that. But just to sort of wrap this up for us, you said a few things like, don't not sell, but sell if you've got strong brand, strong growth, everything else. So coming back to that thing I raised earlier, I mean, is it really a good time to sell, or are there any specific reasons you should bother to sell right now in this environment?
It really is case by case. Seriously, I mean, I spoke to somebody about a month ago who was really adamant about going to market, really adamant about selling the business, and I was just very blunt with this particular person and just said, look, your margins aren't there yet. Your brand is okay, but you've just started to kind of turn the ship around. You really need to wait. And oh, by the way, if you go to market now, you might get a bid, you might sell your business. I'm not saying you might not. I'm just saying your chances are much more slim, and you should expect a low multiple, at least with the thing that you care about, which is cash up front. And so that's one case. Another case, we had a $40 million top line business, Vendor Central, on their way to $6.5 million of EBITDA. They've got a real shot at PE, no question. And so they're our client. We're taking them to market. We're shopping them to, a select number of private equity shops, because we just know the aggregators won't touch it, mainly because it's Vendor Central and et cetera. But business has been around for 10 years. It's got a good brand. It's got real awareness. It's been featured in lots of different publications, so it's case by case, right? Whereas it was just like, in early 21, you couldn't pick up the phone fast enough of people wanting to sell their company. And you just knew that the liquidity chasing it, as long as it has a pulse, is probably going to buy it. So it's just changed. We're in a traditional environment now. I mean, look, M&A traditionally has been not everybody can sell your business. We went through this period where a lot of inflated egos popped out because they were getting 20 emails a day from all these aggregators thinking, everybody wants my business. And that's never been the case in the history of business. And so we're just entering a more traditional, professionalized environment, and you got to be really darn good at what you do as a business owner. And that's why it's now case by case.
Yeah, that makes a lot of sense. Although I would say that you're kind of backing your own thesis, because you said that, the criteria for being able to sell: great brand, good profitability, growth. And I guess that growth and longevity of the business kind of show, are two sides of the same coin. Because if you've got a 10-year, ramp over which you can show growth, then you've got a lot more history to show that the possibility that will continue into the future rather than 1 year, I guess, right? Or not 1 year would be extreme, but
that's right.
Great. Well, look, we ought to wrap this one up because I do want to
Okay.
get to a little bite-sized episode about investment in businesses, which I'm quite excited about because it's something I've had my personal thesis that this should exist for several years and hasn't seemed to have done. So first of all, what do you guys offer? You mentioned consulting services, you mentioned
absolutely.
services. So what do you do?
Yeah, look, for your viewers listening, anybody listening, by all means, reach out. You can go to my website, fill out the consultation form, or my email address is on the website. So just send me an email and I can give you just a good, solid assessment. We'll spend 30 minutes together and I can tell you exactly where you are and where you need to be. And yes, we offer a suite of potential services where if you need growth consulting or you need really strong advisory or exit planning today to maybe go to market in 2 years, but we go ahead and start the process of restructuring the company to where it's on the right path towards an exit. That whole idea of kind of anticipating where the hockey puck is going to be, right? Or the football.
Skate where the puck is going. Yeah, no,
that's right.
Exactly. Americans use British metaphors because I mean, in football, normally you don't normally kick it the whole way down the pitch, whereas I guess in American football you probably throw it 80 yards or something ridiculous, right?
Well, I don't know I don't know who got it, but I follow Liverpool and Darwin Núñez is now one of my favorite players. That guy is just going to be an animal. And I saw some goals where he had to anticipate exactly where to be on the pitch, right, around the goalkeeper to get the ball inside. So
I stand corrected. I mean, I know very little about sports, so I shouldn't even mention that. But so whichever sport you play, in short, and I guess whichever sort of sector of e-commerce you're in, it sounds like you need to get somebody who's got really good foretailing powers, which is a really dark art. And we've had Joe on is it Joe Salmon? No, Rob Salmon, and we had Joe. Remind me what Joe's second name is.
Oh, Joe Hogg. Yeah.
Joe Hogg, yeah. So Joe Hogg and your research team and the guys who try to see, where the puck's going, where the football's going, whichever shape the football is. So yeah, those guys are really, really great. And I know you've got some great insights and publications that you guys do as well. So if people want to get to the site Global Wired Advisors with an ORS, or is trying to spell it with an E for some reason, that's the place to go to check it out. Chris, really great to talk to you. We're going to get you back on to talk about investments, or partial selling a bit of your company, but not giving the whole thing up, which I'm sure a lot of more ambitious owners I know would be super keen on. Literally had a client about 3 weeks ago who refused an offer from an aggregator because he didn't think it was, I thought it was actually pretty generous for where he was at in the business, but he wants to grow it. He wants investment, not a sale. So that's a great thing. So if you're listening, that's going to whet your appetite. Meanwhile, for the moment, Chris, thank you so much for coming on.
Thank you, Mike. Appreciate it, man.
And straight back into the studio. Here we go. Ladies and gentlemen, here we are again at the 10K Collective podcast for 6, 7, and 8-figure Amazon sellers, or should I say e-commerce business owners who happen to be over-concentrated on Amazon at the moment. So let's talk to Chris Schipferling from Global Wired Advisors. Today, we're going to talk to him about the ability to get investments from outside of your business rather than just sell your business.
That's right.
So quite an exciting option. Chris, welcome back to the show.
Thank you. Appreciate it.
Yeah, it's been so long since we talked.
I know, man.
So tell us.
Look, in dog years, it was a long time.
In dog years, yeah. So I've been surprised at the absence of this, when I was amazed by the fact that aggregators overlooked the concentration risk of Amazon, which we discussed in the previous episode, which if you haven't listened to it, folks, do listen to that.
Yeah.
Very important to stay up to date with the market for businesses as a whole rather than just products markets. But what I would say is I've been amazed at the lack of, on the other hand, people willing to invest risk capital. So in other words, accepting that it may go to zero, but as a part of their portfolio, risking 10, 20, 30% equity investments in an e-commerce business. I've been living in near the city of London for years, thinking I've on the one hand got these 6, 7, and even 8-figure Amazon business owners. On the other hand, a bunch of people that I know who invest in businesses. And finally, it seems like you're one of the people that's helping to bridge that gap. So tell me more about this, what you've seen, why have you got into this?
Yeah, absolutely. I'll kind of give you kind of the little bit of the background. So about a year and some change, Yoni and Lippy from Escala Multiply Me called me up and said, we've got an idea. And we think that by providing minority investment inside of these e-commerce brands, and coming in with real resource capabilities, providing capital and resource. We think that in 2 years, 24 months, these businesses will be in much better shape, a much better asset to then sell and go to market. So that idea was kind of birthed back then by those guys. And then from there, I started talking to Sellers Funding, and Sellers Funding, of course, they also simultaneous had a little bit of the same type of thought process. And we just brought the brain trust together and said, hey, look, this is a really good idea. We knew it even in the heat of the market where all these aggregators were chasing all of these brands. And we said, you know what, it's more than just coming in and let's make their PPC better. And it's more than just, hey, let's optimize the listing. It's no, let's actually transform these into brands that show really good growth. So what does that actually look like? Well, it looks like they need capital, because that's the biggest constraint. And when you're growing, you need money for inventory, right? Well, what else do you need money for when it comes to becoming a brand? Well, you've got to start looking at placement, right? One of the 4 P's of marketing. Where am I being placed? 100% Amazon? Got it. So now we need to think about the direct-to-consumer channel, which is your website or Shopify or whatever you want to call it. Okay, what about retail? What does a retail strategy look like? Now, again, we only have 24 months. So we're either starting the retail strategy and building it, or we're starting it, building it, and starting the execution of it. All right, well, what else is needed? So that's all kind of placement. Well, what about product? Because that's another part of the P's, right? Okay, most of these brand owners don't have a product roadmap. They've never even done real product development work. And I'm not disparaging, so I'm going to take a couple steps back and say, look, there's plenty that have. But I've also in 5 years talked to a lot of business owners. So I know I've got credibility when I say this. I'm not just making this up. There's no sense of product roadmap. There's really no sense of product is king. It really is, I've got a widget and I'm going to try and squeeze the widget out of much lemon, juice out of the lemon, called profitability, until it commoditizes and I move on to the next widget. Well, let's apply real traditional CPG tenets of product development, building out a roadmap, building out a story, building out a narrative, creating real innovation. Okay, so that's going to require capital and consultants, and it's going to require time and help, right? So you got the product, you got the placement, and then of course it comes to the marketing, right? So how can we help from a marketing perspective? Well, lots of these businesses have never done a SWOT analysis, right? Where we look at the strengths, weaknesses, opportunities, and the threats, and we go, okay, what can we capitalize on out of these? Where can we really capitalize? Where can we protect the brand? So we're really kind of looking at the conveyor belt of finding a really good business, roughly doing 3 to 6 million in revenue, that has the opportunity, the inflection to really show strong growth. They just need resource. And so we said, you know what? I think there's a huge need for this. The market was starting to then dip, and we realized there was an even bigger need as the market dipped more. And as we talked about on our prior podcast, the need for kind of putting your head down and growing because the market is correcting. A lot of business owners are looking for that help. We said, look, let's do that. We're going to provide capital, resources, and then we're aiming towards 24 months to have a dream exit. That's what we're looking for.
Amazing. And that makes so much sense to me. I just want to say that the businesses that I work with in the sort of higher end of the businesses I work with in the mastermind are exactly in that kind of position. And I think this is wonderful because a lot of business owners don't want to exit when a business is small because they're ambitious. I know people who could exit probably or could have done in the last, maybe not now, but in 2021 when things are going crazy, they could have exited for $1 million. But that wasn't the split between 2 business partners was not going to provide them with a retirement package and allow them to put their kids to university and the things they want to do. They need to walk away with a few $1 million or pounds a piece. If you live in London, that's not a lot of money if you want to pay your mortgage off. It really is not. I mean, all the houses in my road probably worth $4 million a piece, and they're not spectacular. They're just average
I know.
These
We're catching up even here in
sorry
North
about that.
Carolina.
Catching
Yeah, my
the
home
disease.
value went up like 200% through COVID. It was
Yeah, I mean,
insane.
look, we're going to go through choppy water there, but I suppose what I'm saying is that,
Yeah.
that there's not, once you add it all up, there is a need to really grow a significant size asset if you really actually want to retire or actually have a lifestyle change, which, merits all the
No,
work.
it's true.
I like the way you're thinking and allowing people to time that exit, not rather than being timed by the market. The aggregators force you in a sense to either sell now or forget it, that you're allowing people to have a longer term ambition, which
That's
is
right.
really great. For the good brands, why would you want to sell a really great brand?
No, it's true. And so that's the overall kind of broad sense of what we're doing. We're selective in who we take on. We do a lot of diligence, obviously. So Global Wired Advisors is involved as an equity stakeholder. When we sell the business, there's no broker fee. There's no fee that's being taken because we're an equity stakeholder. Escala Multiply Me, Escala comes in, does all of their process mapping, cleans the business up for scale. Then Multiply Me, we actually place people with no cost burden into the business to help work on different aspects of the company that need help. And then of course, Sellers Funding is providing the capital. The way the capital works, it's a working capital product. So you get an injection of capital that does have to be paid back in it's a 3-year loan. However, it's interest only for 2 years. So there's no real cost burden. And we're talking about injecting like 800,000, $1 million, $1.2 million, like big numbers into the company to show big growth. So we got 24 months, interest only. There's no other product like this anywhere out there, period. And we got 24 months to grow the brand, inflection, and then you're right, taking it from 800,000 SDE to 2 million of SDE or adjusted EBITDA. And now all of a sudden you can take it, you've transformed it to its fully optimized best fit, right? Think of it like a personal trainer coming in and getting you in the best shape. We're going to get the company together in the best shape. And then we're going to go off and we're going to try and sell it to what we would believe would be the best strategic fit. This might be an aggregator. And what I've been saying is this accelerator this is the perfect fit for an aggregator because they're always looking for businesses that are now looking for a specific criteria where they can take them over. And instead of arbitrage, I can take them over and the growth, someone cleaned this whole thing up and made it a brand where I can just add more capital and all of a sudden in my own resources, and now the brand has real flywheel material. And
so you guys have kind of acted almost, this is starting to feel a bit more like I've been looking to Y Combinator sort of videos just to get a bit of wisdom for startups, because I've realized that although I dismissed the startup, I don't mean dismissed either as a category, but I dismissed the startup mentality and thinking because it's venture backed and it's got a different, more ambitious aim than the average e-commerce business. I've realized they have more in common than I thought. And what you're talking about is almost like a sort of Series A investment plus advisors that then allows you to go on to, not an IPO, but almost the equivalent of selling onto a bigger entity, not the capital markets of the world, but an aggregator who has maybe Goldman Sachs behind them if they're still in that market in 2 years.
Yeah, something like that.
That makes sense. So it's a different play and a less aggressive play. It strikes me a more sustainable play. That's what.
Right, and you think about it. Look, we got 2 years. Global Wired has plenty of time to get all the financials ready, make sure the company is headed down the right path. We got all the answers to the test when it comes to what we know the capital providers are looking for. And it gives us 2 years to start talking to private equity and lots of different folks about the asset. So, I mean, just from that perspective, it's wildly valuable because you give the experts more time to do work. Escala, the experts in business consulting for e-commerce brands. You give them plenty of time instead of just like this 3-month project. You give them plenty of time to make sure that the asset is fully cleaned up. Multiply Me is getting their tenants in and doing the work that needs to be done. And then we've got a bench of outside consultants, and this is where our strength really starts to shine because we have a bench of outside consultants that are not known in this space. Nobody knows who these people are, and they come from Fortune 100, Fortune 500, Fortune 1000 companies where you're getting that enterprise. So when I talk about, like in our other podcast, that, hey, this is a chance for you to really become a brand. And I know a lot of business owners think, well, what the heck do you mean? How can I have access to any of what you said? The reality is a lot of that access is already here. I mean, just take product development. Gemba is somebody that's in this space. And I've had good conversations with those guys, and they get it. They really understand the product development innovation process. I mean, they're experts. They came from big Fortune 100 or Fortune 500 companies. So, I mean, that level of expertise is available. You just have to be willing to A, do it, and B, find it. Well, with us, we're your shortcut. You know, we can pull, you need help when it comes to sourcing in Asia and working with your factories. We've got someone who actually was a CEO of a manufacturer for 4 years in Southern China. You know, you need help from a director or from brand marketing, just brand marketing, which is something that a lot of Amazon sellers don't do a lot of work with, because it's much different than just digital marketing. We got a stacked bench of what we would call the best resources. And so, look, I'm making us sound like the Avengers. So let me repeal it back a little bit. We just know this is a much needed product for the space right now. And we believe it's a product in both a bear and bull market.
Yeah,
and
I'm totally back you on that thesis. I really think I've been looking for something like this for sellers for years, because I've been thinking, I know some really solid small business owners
That's
who
right.
can become medium or even big businesses, but they need capital and they need the stuff that you're talking about. And I don't have that access to that stuff.
That's
but
right.
I know a person who does know a person. Talking of which, you're making it sound incredibly attractive. So it's a businesses doing your sort of target businesses, $3 to $6 million in revenue approximately, as the opportunity for strong growth, of course. Is there I mean, tell me about who else, the eligibility criteria, who should be getting in touch with this exciting sounding possibility.
Yeah, I mean, look,
where would they need to be selling? Where would the businesses need to be based?
Yeah, look, if you're 100% concentrated on Amazon or 100% concentrated on Shopify, it doesn't matter. You know, for us, as long as you're most of who we're going to work with will be digital first. But there are going to be folks who come to us and they're purely retail and they have no digital. I mean, that's the beautiful thing here, is that we are extremely diverse in who we can work with when it comes to current channels of distribution. And as far as category,
I was going to say geographically was the other question. Like, if they
doesn't matter.
Sell in the US or
doesn't matter.
Based in the US, sell in UK, or like sell anywhere. Okay.
Our first asset under management is from Australia. It doesn't matter. It's just a matter of getting the operating agreement to comply with local law. That's about it.
Yeah, just that matter. Yeah, but that's the sort of thing you got to jump through anyway. Amazing, because I can imagine some people listening to podcasts who I know personally in the mastermind would be pretty interested in this, and I am very interested on their behalf. This does sound like a really strong proposition. So if people want to approach you about this and they think that, you know, I think they're hard enough, as we say in the UK, you think you're man or woman enough to qualify for this pretty amazing sounding system, where do they go? What do they do? Yeah,
so it actually gives me a chance to tell you what our brand name is and give you a little backstory on that. So the brand is called, the fund is called South Call. South Call is the final base camp before you hit the top of Everest. So the idea is, okay, you've come this far as a brand owner, you've done a lot of blood, sweat, and tears. We want to be your Sherpa to help you reach the peak.
And what was the name of that brand again?
South Call, SOUTHCOL, South Call. It's the final base camp before you get to Everest. And so the top of Everest. So the idea is playing on the whole analogy of you've climbed the mountain thus far. This last several miles are hard, but let's do it together, right? We also call ourselves the helpers, not the heroes. We're there to equip, empower, and to help. We're not, and that's why I wanted to repeal the whole Avenger mentality, because we're not the heroes here. We're working together.
Well, it sounds more professional than that. I mean, okay, it's exciting, but it sounds like you're people doing real, proper branding and business building work. You know, you're more like expert, you know, chemical or structural civil engineers than anything else that strikes me. It's like calling in Balfour Beatty to build your building, your skyscraper.
Yeah.
If people want to check this out, I mean, I've just Googled South Col and I can see lots of pictures of Everest, which is great. But where do people go?
Southcol.co. Yeah, SOUTHCOL.co. That's our website. It'll just give us about 6 months, and that will index on Google and be #1 when you put in South Call.
I'm sure it will be. Yeah, no criticism like your SEO. I'm no good at SEO. I'm not a guy,
Yeah.
but
So,
that's great. So South Call, COL.
yeah, so we have an
Yeah,
application
I'll check
there.
it out.
Basically, what you do is you just fill out the application. It's a proprietary it's a proprietary application. So you can, basically link your Amazon, Shopify store, put all your financials, link in your Xero account or your QuickBooks. That all comes to us, and we in effect, start our diligence at that point, and really kind of take a first look at, is this something that we should pursue? Here's the great news: if it's not a South Call candidate, you still have Sellers Funding, Escala Multiply Me, and Global Wired involved in the business, taking a look at all of your numbers and information, and then giving you really great advice on, here's probably what you should do next. You're not a South Call candidate, but here's what you should do next.
Well, that was exactly what I was going to say. Like, I would so strongly advise anyone, because I know Yanni and his team from the Multiply Me, super sharp guy.
Awesome.
Like, scaled a team from 4 people to 100 and something in a year. I mean, insane.
I know.
And he's still in business. I mean, like, to do that and then collapse would be normal, but to do that and be in business.
He didn't stall the plane out, man.
No, exactly. Super sharp. So, you're talking to really, really sharp people. You guys, you, Jason, the guys over at Global Wide Advisors. So all I can say is, if it's a possibility, you should check it out. Well, listen, I'm going to have to dash, because I've got to go and do more mundane things like have some dinner in London. But it's been a real pleasure and an eye-opener to talk to you, Chris. And
you too, man.
Delighted to hear about this.
Really appreciate it.
So just the final call to anyone who's roughly in the sort of ballpark of what they're looking at. So $3 to $5 million roughly in revenue, and strong growth, strongish brand, but could be better. southcol.co is where you want to go. Chris, it's always a pleasure. Thank you.
Always to you too.
All
right, take care. Thank you.
Thank you very much for staying with us live, folks. If you've got any more questions, then do just pop them in the chat.